Good morning. Okay, so just as everyone is filtering in, obviously we're here today to talk about planning. It's a huge topic right now. There's a lot of change. Some of the original changes did not go down particularly well. So this is one of the things we're going to be discussing today. But just while you're all sort of filtering in, I'll give everyone a few minutes. I'm going to do a really quick poll right now. Our next webinar, we're trying to sort of understand which topic you'd like us to cover. We want to do something instructional and educational. So if you could just sort of vote and let us know what you think would be a better topic, then we will know what to cover. So this is the question. What topic would you like us to cover in our next webinar? Either modeling new tenures in ProVal. There's a lot of different new tenures coming out, and they are quite tricky things generally to model. And we know that a lot of people struggle with that. So would you like us to do something about that? Or would you like us to cover how to streamline your sales process? Please do let us know. And like I said, we'll just give people a few minutes to filter in just before we start. Great. Okay, well, this is pretty unanimous. This is looking like everyone wants to model new tenures in ProVal. Okay, great. Excellent. Okay, we seem to have peaked attendee-wise, and the poll is pretty unanimous. Great, thank you very much. Okay, right, so here we are today. Our previous webinar discussed the proposed changes, including removing Section 106, giving funds directly to unprepared local authorities, fueling NIMBY friction with open planning referendums, and extending right to buy to housing associations. And none of this went down particularly well to our customers, and it didn't really do anything to affect supply. So we're hoping that since then things have changed a little. We're at the AHO conference recently, and one of the proprietors of Homes England did say that Homes England was actually originally set up with CPO powers. And in the entire history of Homes England, it's only ever used a CPO power once. What it did turn into, however, is a grant funder. So why did that happen? I'm not exactly sure. It would be good to sort of understand Jonathan's perspective on that. And I'll just now give the stage to you, Jonathan.
Thanks, Chris. I should be clear, I am not Homes England.
No, I totally understand that.
just to avoid any confusion.
Absolutely.
But yeah, so the regulator, we're obviously a very, very interested observer of what's going on within planning, within new supply, within the kind of wider government, local government ecosystem, if you like. So I can give you some sort of observations in terms of what we're seeing and where we think things might go next. But really, I think the value will come hopefully from the questions and the discussion. So I'll talk for a short period, but then really it'd be really good to get some debate going.
Absolutely.
So a few observations, just looking back over the last 2 or 3 years. So the sort of housing association, the traditional housing association sector, and we might come on and talk about some of the for-profits and the new entrants and the new people that are moving into this space, because it is becoming increasingly of interest, I think, to a range of different players, which I think is an interesting dynamic in itself. But if you just look back at the sort of what we think of as the bread and butter housing association world, you know, the sort of all the big names we all know and love that probably a lot of you will work for, they have been churning along since 2010, churning out 40 to 50,000 homes a year across a range of tenures, generally weighted towards rented, but we've seen an increasing spike towards shared ownership, build for outright sale, and a certain amount, much smaller amount of market rent activity going on within housing associations. What we see within that is, again, is extreme concentration. So we have sort of 200 larger housing associations, if you like. Something like 85% of all the market-facing activity, so build for outright sale, build for market rent, is going on within, say, 20 of those organizations, and that 85% is being done by those top 20. Everybody else in this constellation, if you like, is basically churning out, either taking 106 at the end of a developer pipeline, or is taking on small amounts of land-led delivery, but essentially that is focused on social and affordable rent and shared ownership, and that remains, I think, the bread and butter of what housing associations have been doing. What we saw going into the pandemic is people were looking at about 40 to 50,000 homes in total. During the pandemic, expectations about future supply dropped away, and we saw people significantly reduce overall expectations. So when we looked at people's plans in 2020 and in 2021, we saw appetite and risk, going to risk off, and people were scaling back. And interestingly, people were particularly scaling back on the market-facing tenures. So we saw even within that group of 20, the amount of sale activity, the amount of market rent activity they were looking at developing was scaling right back. What is interesting now is people are reappraising where they're going, and I think sort of coming out of the pandemic and moving into this post-pandemic world, but a world of significantly higher inflation, of rising interest rates, and I think probably more uncertainty about the future of the housing market than we've seen previously. We're seeing people moving back to that kind of risk-off position. So we went into the pandemic, people went risk-off, they scaled back down. Coming out of the pandemic last year, they were beginning to scale back up. People were beginning to put plans together that you would see, again, back to traditional 40, 50,000 homes, a bit of shift into market sale. That's reversing again now. And next week, we're getting in everyone's business plans. So we'll have a much better read in about a month's time, a much better read on where the sector is actually going. But our initial discussions and consultations suggest that the traditional housing association market is scaling back its development ambition, and is scaling back its risk appetite within that development ambition. So we are definitely seeing the sector moving away in aggregate from building for outright sale. We're seeing the sector moving away in aggregate from market rent. And we're seeing much more interest in building rented properties and, to a certain extent, shared ownership. Now, that's from my background as a kind of finance person, that's really interesting, because the question then emerges: how do you finance the construction of those homes? Because the profits on the new sales was what was actually cross-subsidizing a lot of the new supply, given the really constrained grant world that we live in. Yeah. So at the moment, the model for most traditional housing associations is kind of, we're going to have to take on more debt, but there is a limit to which your balance sheet can continue to sustain the increased levels of debt to make up for the reduced amount of sales income you've got. Or, and this is where we get into the for-profit world, or you look at other structures, other delivery mechanisms, other financing mechanisms that might allow you to keep the quantum of homes that you had in your business plan previously to be delivered. So essentially, the model before the pandemic was a small amount of grant, a fairly big slug of cross-subsidy from elsewhere in the business, largely from sales activity or historic surpluses, and then a big chunk of just debt being serviced by the unit that you were building. Okay. That chunk that was being financed from the cross-market, the sales activity, that's being taken out. Initially, that's coming from additional debt, but that's not sustainable in the long term. And I think that is what is driving organizations to be interested in where else do they find value in the business to cross-subsidize into new supply, which I think is what is leading to some of the conversations about disposing residual Section 106 properties. And that, we know there's a reasonably active market of commercial new entrants looking to come into the sector and buy, residual shared ownership, which has a value to them because of the income stream and the potential for capital appreciation over the longer term. Yeah. But that releases cash right now that you can then put into your business plan. I think part of the issue here is that is only part of the story, because even within a HA business, the competition for that new capital has become more intense. So whereas for the last 10 years, the focus, I think, really has been on new supply, and the development department has probably had first dibs on the available capital in the business, increasingly the maintenance, the asset management side of the business is saying, we've got building safety, we've got EPCC, we've got zero carbon, we've got Decent Homes 2 coming down the track. We need capital now to invest in our business. It isn't just about the revenue reinvestment. This is about we need capital investment into the business. And that means, I think, we're beginning to see within associations a real battle going on about where do you apply future funds between existing stock and new supply. I think that comes at a really interesting moment in the planning system with this uncertainty, lack of clarity over what's happening with the future of 106. Will the infrastructure levy, what will that provide? And real question marks. So we have an issue about what the availability of supply of build opportunities are going to be, and we have an issue around the capacity and risk appetite of housing associations to engage in that activity, which I think, as we see it, is leading to a great deal of market uncertainty, and people don't quite know how to bid for or how to price opportunities is what we're hearing from people. Again, really interested to hear what people have got to say about that. The piece that's coming in, I think, that is making the difference at the moment, is really supporting market and really supporting land values in this sector, is the emergence of for-profits and new entrants. We may have some people on the call that are from that part of the market, but we've got actors like LNG and Sage, who are, and others coming in behind them. Actually, those are the two big ones that have kind of really put their head above the parapet. But in our role as a register of new entrants, we're seeing quite a lot of big publicly listed companies entering into this space and registering subsidiaries, commercial subsidiaries, to come in and facilitate similar things. So people who are on the record, British Land are in, Granger Trust are in, and a number of the other big sort of land investors, land trusts are coming into this sector, and that's having, I think, an effect to push up 106 prices. I think it's having an effect to push up prices more broadly for development and supply. And there's a real question, I think, to what extent the housing associations get involved in that bid, in that process. And there's a real danger, I think, for housing associations that they have traditionally been seen as kind of the last man standing. So they are the people that will carry on even when all the others, head for the door. So I think it feels to me, Chris, we're in a real inflection point around future supply, where associations don't quite know where they want to position their business given the existing pressures on the existing stock, given balance sheet constraints, given new entrants coming into the market, and giving uncertainty on planning. That feels like a bit of a perfect storm. And then you lay over that the overall fiscal uncertainty around inflation, interest rates, rent levels going forward. What we're seeing is a real hesitancy, and as I say, a move to a kind of risk-off position around supply, because people don't feel they've got the certainty to know that they can plan 4 or 5 years hence a development program that is 40, 50,000, 60,000 units. So we I think are interested in, as I'm sure everyone's called, is what are the people like Homes England, what are the GLA, what is central government, what are local authorities going to do, and can they provide certainty in that environment that allows developers, housing associations and others to carry on building? Because actually, economically, the worst thing now would be for all the house builders and all the housing associations to down tool and sit on their hands and wait this out. So there's a definite government fiscal treasury interest in continuing house building. Most of the government interventions have been on the demand side. I mean, our sense is there actually now needs to be some more interventions on the supply side. How do you release more land? How do you free up the planning system? Questions that you will be much more au fait with than I am. We're not seeing any, well, obviously there's no silver bullet, but what we're seeing at the moment is just more and more fog. And it's really interesting from where we sit in our engagement with government. For the last 10 years, the question we've been challenged about by central government has been, what can you do to encourage supply? What can you do to help people provide more homes? That is not the question we are being asked by government now. The question we're being asked about government now is, how can you improve the condition of the existing stock? How are you going to get the stock to zero carbon? How are you going to ensure that the things we've all been seeing on ITV News in terms of tenants experiencing very poor outcomes, how are you going to make sure that's being addressed? And how are you sure that the HA sector is delivering on those issues, rather than how is it solving the supply question, which I think is really interesting. I've been in the sector for 20 years. This is the first time the debate has changed so fundamentally. And it really feels as though from DLUC's position, the question is more about the existing stock. and less about the new supply, which I feels to me like quite an inflection point. And I don't know whether that's a temporary thing, whether that's a kind of social media driven thing, or whether that's actually a shift in government policy that we'll see play out over the next few years.
Okay.
I feel like I've said sort of
You have.
So, trying a few hand grenades in. Really happy to sort of take questions.
We are. Okay, so we're open to questions now. Please do let us know. Does any of that chime with you? Would you like to discuss any of that further? Jonathan, just one from me here. In terms of disposal schemes, is ethical disposal schemes, is it going to be something that you think that, you know, housing associations, registered providers are going to have to take a benefit from?
So you mean disposing of existing social housing stock to fund
new growth?
Run new growth. So I think this probably falls into at least 2 or 3 categories. So you've got the residual shared ownership being released into, you know, to another provider to release cash, and that could be going to a for-profit registered provider. Actually, unlike social rented, it could also, so shared ownership can be disposed of into the open market. So you wouldn't have to sell it to a registered entity. I think most local authorities, most planning departments would be very concerned if it was leaving the sector, but legally there would be nothing to stop that happening. As a regulator, we're much keener to see that stock stay within the regulated sector, whether that's in the for-profit or sell to another not-for-profit. So I think we're reasonably relaxed about the disposal of shared ownership, because the resident has lots of protections built into the lease, and that's the primary way they get their protection. So the lease isn't affected by the sale, and therefore we're reasonably relaxed about that. Where I think it gets more problematic is where we're beginning to have some of these conversations are beginning to be had in the sector, is about disposal of rented stock outside of the sector. And again, that comes in 2 flavors. You've got ones with sitting tenants and ones without sitting tenants.
Okay.
Now, clearly the stock without a tenant in it, void stock, that's gone on for a long time. And the question at the moment about that is the quantum point. So how much stock is going to be disposed of into the sector, into what markets are they going to be disposed of? Where we're seeing this play out most, in low demand areas where you've got significant EPCC or zero carbon type bills potentially for stock that's going to be very expensive to bring up to that level, registered providers, I think, are having discussions about, do we dispose of that stock? Do we try and bring it up to those levels? Do we have to dispose of a portion of it to bring the rest up? How does that work? And I think those are much more difficult conversations. Particularly often what you'll be doing is disposing of into reasonably fragile housing markets with probably an unregulated PRS that might not, that might not be the best thing for that locality, to have a load of stock move from the social rented sector into an unregulated PRS sector. But you can see rationally why associations are looking at that. I think where the red lines start coming for us as a regulator is disposing of stock with sitting tenants into it outside of the sector. I think if we were to start seeing that happening, that's the sort of thing where as a regulator we begin to get really concerned.
Okay, that's good to know. I mean, when you're running out of options and you have a lot of stock which is starting to drag you down financially, it seems like one of the only sort of exit valves is to do that. So there was an ethical disposal scheme, because obviously one of the remits of housing associations is to increase supply as a whole, rather than necessarily deliver and hold on to the houses themselves. And to stop the properties from falling into the private rent sector. So you have a property, it's in absolutely terrible condition. You have to get rid of it, and then it ends up in the private rent sector, and then a landlord just sort of puts it out as is, and what you've ended up with is something out there that's quite bad. So one of the schemes that I heard about Brighton CIH was they would basically turn the homes into first buy schemes, so that, and just completely gut them and say to the people coming in, first time homeowners, if you can do the work on this, we will help you on it. And that to me seems like a really great idea, because you're solving 2 problems at once.
Yeah, and we've seen those sort of schemes in the past. I know sort of in Merseyside, Riverside, for a long time, we've had a kind of homesteading project where you dispose of terraced houses to first-time buyers, which has the effect of actually hopefully bringing in more economically active people into areas, which helps the area itself, but also helps the asset, and as you say, helps take liabilities off your balance sheet, even if actually the net cash flow to the business is quite small because you have to dispose of it at such a low price, but you're taking a liability off the balance sheet. You're improving the areas in which you work, and you're giving people a route into home ownership. So I think done properly, I think those can be real win-win ideas.
Thank you. So still have some, so no one has asked a question yet. This is very unusual. There's 67 of you. Surely someone's got a question. In the meantime, Jonathan, Duncan Smith from WHG is a commercial director. We often have him here, and he's very vocal about his views generally. And he sort of said that a mild recession provides favorable conditions for registered providers. Now, we don't want, obviously, he didn't mean that in a way that would be, taking advantage of the situation or anything like that, but it can actually be wind behind a registered provider's sail. However, a deeper recession is extremely poor for the sector, because obviously your voids and bad rents and debts go up. So as if we do fall, and we are looking at a really difficult economic situation here. We have inflation out of control. The Bank of England was asleep at the wheel. We also have now a bunch of strikes, just a whole domino effect happening right now, which again could threaten hyperinflation if everyone gets these big pay rises. So what is your view on if we do go into a deeper, darker recession on the entire sector profile risk? Are you predicting that it could fall quite deep?
So I think there are a number of things that play out in providers' business plans that create real risk. So you talked about inflation, and one of the things that is most damaging to housing association businesses is differential inflation rates. So when your rents are going up at a different rate to the costs you're experiencing in your business plan. And obviously, a few years ago, we had 4 years of rent cuts, but actually inflation was quite low. So although it was damaging, undoubtedly it was damaging to the financial position of providers, it was manageable because the differential inflation rate was actually quite low. This year, rents have gone up by 4%, but people have been experiencing rent on the cost base, so inflation on the cost base of 10% plus. So people have been taking a real terms cut in rent levels. That's already beginning to play, and that was in my opening remarks. That's what I'm sort of saying, that's affecting ambition going forward on development, because that's one of the areas you might look to scale back on if you're facing constraints within your existing business. Going forward, we know that the September forecast for September CPI are possibly double digit. Certainly CPI plus 1 is going to lead to rent increases of more than 10%. And there is a real debate going on right throughout the sector about, can we do that to our customers? Irrespective of whether government does something about rent levels, which it might or might not. But just as there's a debate in the sector, the customers are going to go through a winter of significant energy price rises, and at the end of that, they get a rent increase that is in double digits. Household finances are under increasing, under incredible strain. Is that going to be a legitimate thing for a provider to do? So really difficult questions. Because if you don't put your rents up, you are going to be experiencing massive differential inflation in your business. And it only takes 2 or 3 years of differential inflation rates of 5% plus to really erode financial capacity out of business plans. And at that point, I think supply does really start taking the hit. The question has been, so you're right, the early 90s recession and the late post-financial crisis downturn, both of those saw government interventions in the housing market, which were actually beneficial to housing associations. So the 1990s, HAs brought up a whole load of street properties with the backing of government, and that significantly expanded the asset base of a lot of associations really early on. And in the early sort of post-financial crisis downturn, the sector benefited an awful lot from additional grant rates to enable them to convert unsold shared ownership and unsold properties to rented properties. And again, that had a really beneficial impact on the balance sheet. The question is, given the state of the public finances, which I think are now much more constrained than they were in the early 1990s or the late noughties, will government do something again which will be actually financially beneficial to housing associations? And at this point, it's really hard to tell. Well, it'll be hard to tell, frankly, who will be empowered by the time this happens and what the appetite is of either of the major political parties to intervene in this way. My sense would be that Treasury will want to do something because keeping the housing market going, keeping construction going, keeping building going through a downturn is a really good way of generating the GDP multiplier. And government intervention there is helpful. I think we might see something, but I think we could see some casualties in the HA sector before that sort of cavalry arrive, given the sort of differential cost pressures and rising interest rates.
Do you think that they're going to wait for the ship to sink a little before they actually do anything?
I mean, that's the question that's way above my pay grade. I mean,
Sure.
Governments often need evidence before they move, and Treasury will always be suspicious that there's a bit of special pleading going on. So I think a case will have to be built for that to happen.
Okay, thank you. Well, we have some questions. So Barbara Kerr, will regeneration projects be a way to increase stock and upgrade?
This is absolutely fascinating, because obviously regeneration has been a dirty word in government for the past 10 years. And we have begun to see, I think with Michael Gove and with Boris Johnson, actually, regeneration being talked about in more positive terms. And certainly one of the things, there's been a lot of coverage of poor quality stock on ITV News and on the social media. And a lot of that is in blocks that are earmarked for regeneration, but regeneration that's taking a long time to arrive because it's financially very difficult. It's very complex, getting the planning agreed. It's just horrendous. So I think that there's a real case that the sector can build here, actually, that if politicians want to address what they're saying on social media, a really good way to do that is to drive regeneration forward. And whether that's about, you were talking about CPO powers before, Chris, but whether that's about planning, some way of short-circuiting the planning circuit to get regeneration through, whether that's about providing additional capacity to do it, or just talking in more beneficial and open terms about regeneration generally, because I say politicians have not wanted to engage with it for a decade or more. I think it feels like now the tide is beginning to turn on that, and I think the sector can build a case that would be beneficial.
What was the key hesitation for regeneration before?
So if you go back to when the tide began to turn, which was the sort of 2010 period, if you remember, I don't know if you've all been involved in the sector quite as long as I have, but in the late noughties, not that far, no. In the late noughties, New Labour had the housing market Pathfinder programme across a series of, I think it was 9 weaker housing market areas in the north of England, and that, which was basically designed to take out a lot of the poorer quality stock and to try and rebalance supply and demand in those housing markets.
Yeah.
That led to the demolition and the CPOing actually of quite a lot of terraced properties. But often that led to properties being tinned up for a couple of years before the thing got demolished, and that generated quite a lot of negative feeling and publicity at the time, and that kind of turned politicians against regeneration, because I think some of it wasn't communicated terribly well to some of the residents, and they weren't brought along on the journey, and therefore they got very done to rather than involved with. And I think that led to a kickback, and that led to a kind of blackening of the name. And then just practically, the housing market crash after 2007-8 meant a lot of the regeneration projects that were on the books at the time suddenly didn't work, because they were all predicated on prices rising for a period. And obviously we had a couple of years of house price falls and low market activity, and some of those just got mothballed and never recovered.
I mean, there's certainly an issue around, I lived in New York for a while, and there's a huge issue around gentrification. And this is the idea of pushing people out of communities and then generally getting raw deals and ending up, being dispersed. And obviously that's a terrible thing. But I'm not really sure why, if that's not done properly, I don't think it can't be done properly. A lot of people, when they get bought out, they get huge portions of money. And we see that actually a lot sometimes in our viability. So I don't see why it can't turn around if it's handled correctly.
I think it can, but I do think it's very difficult. You're talking about people's homes. It's very emotive, so it needs to be handled really well. And the issues with planning, the issues with funding, all of that tend to mean this process can drag on for quite a long time. People inevitably get very frustrated while they think something's going to happen, but they're not sure what it is. And I think that can really compound the issue. So there's a lot that obviously the property owners can do, the associations, the local authorities can do, but some of this I think does need central government to be kind of signalling and showing that regeneration is a really important part of their housing policy.
Okay. Right, thank you very much, Barbara. We're going to move on to Nick Thompson. Nick Thompson, a great debate so far, thanks. Jonathan alluded to traditional HAs working directly with for-profits with different structures. Can you elaborate a bit more on these particular structures?
Yeah, I mean, there's a real range of ways that the new entrants and the existing organisations are working together. So, people like L&G and Sage are owning the properties, but they're not managing them. So they're one level, it's a simple management contract. You provide the management services for the properties owned by these for-profits, and there's quite a lot of that going on, and I think that market will grow. There's quite a lot, not quite a lot. There's a certain amount of disposal of shared ownership, unsold shared ownership equity to for-profit organisations to release cash for the traditional housing association to invest elsewhere in the business. And we're seeing that market's been around for a little while. We're beginning to see that perhaps move a little bit more than we have done in the past. There's always been a tension, there's obviously a pricing tension in there. I think associations value those properties more than the for-profits are willing to pay. But I think we're beginning to see that market, beginning to find the clearing price for some of those deals. So they're beginning to happen a bit more. And then beyond that, I think there are kind of more integrated, proper joint ventures happening. So either organisations setting up a for-profit subsidiary, and we've seen that in one or two places where housing associations either are or are considering setting up a joint venture, and then bringing in another equity player to part own that joint venture. So they'll both have an equity stake in the vehicle. It'll act as a for-profit provider, and that helps unlock a lot of that. And then at the other end of the spectrum, as I say, we've got the commercial entrants themselves coming in and creating for-profit subsidiaries themselves. So we're seeing a whole spectrum of ways that the for-profit and the traditional sector work together. I think inevitably there are tensions in some of those relationships, that they're not always straightforward. It's definitely not a panacea, but I think it's an interesting development in the market, and it's giving HA some other options that they can use.
And we know they need more options.
Exactly, yeah.
Thank you very much, Nick, for that. And we'll move on now to Chetan Chalan, and I hope I pronounced that correctly. Are build contracts linked to BCIS becoming more common?
Honestly, I don't know. We see a mixture. I think one of the issues, one of the fundamental issues is where the risk sits, isn't it, in the relationship between the subcontractor or the developer and the owner and the financer of the thing. And we are beginning to see some of that. I think we're also seeing, we're certainly seeing the death of fixed price contracts. The sense I get is fewer and fewer people are willing to sign up to those, and we are beginning to see failures in the subcontractor chain as well. So people going bust, or subcontractors handing contracts back and saying, I'm just not willing to do it, sometimes at any price and definitely not at this price. So I think we're beginning to see a bit more of that, but I can't say it's becoming a significant trend unless others have got evidence otherwise. We're really interested to know.
Excellent. Thank you. And Steve Hughes, what is Jonathan's take on the new infrastructure levy and whether this is a potentially workable in practice for affordable delivery? Would a reformed and speedier Section 106 process be preferable?
So I don't have a view, in the sense, it's not my job, and as a public official, it's not my job to speculate. As a regulator, I think the thing we do observe is change always leads to uncertainty. Uncertainty tends to lead to hesitation. Hesitation tends to lead to fewer homes being built. So I think the more radical the change, and we've said this privately to government, we've said it on public platforms as well. Yeah. The more radical the change, the more likely there will be a hiatus while everyone works out what the new rules of the game are. And that was certainly the big worry, I think, about the reforms that Jenrick was proposing, was that there were lots of concerns about it. One of the impacts was there was a real concern that might stop supply for a couple of years while everyone works out what the new rules of the game are. I think they're trying to move some way something that's not quite as radical as that. I still think if what you were doing was looking to ensure supply doesn't take a hit at all, I think you just make it more incremental. I think if you think incremental changes is never going to get you to where you need to be, you have to accept a couple of years of pain while everyone or the market readjusts to the new rules, then I think you go for something more radical. It's not really for me to say which of those is the right policy objective to go for, but I think those are the things you're trading off in government, something that gives you better in the longer term versus something that doesn't interrupt supply now. I think politicians of all stripes are inherently more short term, so I think the chances are, the reality is, you'll end up with something that's more incremental than more radical. I don't know.
Yeah. Yeah, absolutely. Thank you very much, Steve. And let's keep our eyes peeled on this section 106. It does seem extremely radical. So Ryan Stevenson, on the regeneration topic, what is Jonathan's opinion on all social regeneration instead of traditional mixed tenure?
Oh, that is a really interesting question. And fashions move around and change on this, don't they? And I'm certainly old enough to remember when mixed communities was absolutely the mantra, and nothing would happen if it wasn't a kind of mixed communities project. More recently, obviously, I think there has been a move towards more developments that have no social housing on them at all, and so you almost end up with the two tenure types being ghettoized. In terms of all social housing, obviously within social housing as a range, it could be affordable, it could be intermediate, it could be social rent, it could be shared ownership. So I think that there is a possibility. I mean, that really will turn on the planning appetite of the local authority, and I think you will see that play out quite differently. There are definitely still estates, parts of the country, where actually what people want is more diversity of tenure and less mono tenure estates. So I think we're unlikely to move back to that world. I think some of the sort of people that take longer term views of places generally want to have a mix of tenures in their properties, but it's very hard to get the economics to work without some sale activity that really generates a significant returns. I mean, and you've got to send a signal to the landowners, early on in the stage about what they will get on their land ultimately, which affects prices. So I think that mono tenure or social only tenure estates will be quite hard to work through economically. So I can see the attraction, but I'm not sure they'll necessarily happen from an economic perspective.
Yeah. Well, it is extremely difficult on a financial level.
Yeah.
Thank you, Ryan. Alistair Jones, is it the case the HAs will be prevented from disposing of EPC worst performing stock into private rented? So here we get back into disposal.
No, yeah, and I think, as I was saying earlier, I think we would always be concerned about rented stock with sitting tenants leaving the sector. So I think if you're disposing with the tenant in situ and they're losing their rights as a social housing tenant, I think we as a regulator would be concerned by that. Is there a hard stop on disposing of void stock? No, there absolutely isn't. There isn't. There's nothing to stop people doing that. I think one of the things that providers will need to think about is the reputational and political risk that flows from doing that at significant scale. As I alluded to earlier, you could easily have local authorities taking quite a dim view of the loss of social housing in their area. They could take a dim view of weak or poorly regulated PRS markets suffering from a significant increase of PRS units. So that's all going to be put into the balance against, we can't actually afford to bring this stock up to EPCC, or even to zero carbon. But then that raises the question: well, who's going to pay? You as a social landlord aren't going to pay for it. I'm pretty confident that a private sector landlord is not going to pay for it. And I think that takes you into a bigger policy debate about what do we do as a nation about a lot of our quite tired old stock, where the value of the stock is probably not much greater than the cost of the works you're going to need to do to bring it to EPCC. And I think that's a question ultimately government are going to have to grapple with, but they will look to landlords to sort that problem out first before I think they begin to act themselves.
Okay. Yeah. Thank you very much. The PRS sector, why isn't it more tightly regulated? It does really impact the social housing sector because one of them is Regulate and has so many new regulations and rules and net zero targets coming in, and one of them doesn't. And until the PRS sector is actually regulated and starts playing by the same rules, there will always be that difficulty, won't there?
I think that, well, I mean, I'm sure everyone will have spotted the renters reform white paper that came out last week, and I think that's a really interesting development, because I mean, it poses a couple of things, well, many things, but two I think that are particularly of interest. One is about getting rid of no fault evictions, but the other I think is around the extension of the decent home standard to the private rented sector, and I think that has caused a degree of consternation amongst the buy-to-let market, because they've never had those sort of standards to meet. And as you say, Chris, one of the things with decent home standard is it can ratchet up over time. So it might start at one level, and we know governments been consulting and thinking about what the new decent home standard might look like, and you can see that over time that might increase the demands placed on private sector landlords in terms of the quality of their stock, and therefore the investment they need to make into it. And I think that could have quite a transformative effect onto the PRS. I mean, I think I would also observe we definitely get a sense from various parts of government that in an ideal world it would have fewer, it wouldn't have the market we have currently in the PRS system. They would like to have fewer bigger landlords who are more well capitalized and more socially responsible, and less of this mass of people all owning one or two properties, and a real variation in the quality of the managing agents that they use to manage that stock. So I think government, it's never put in quite these terms, but I think government would not be adverse to a lot of traditional buy-to-let landlords leaving the market, and it becomes a more institutionalized sector.
Well, I saw some stats recently. A lot of the properties, buy-to-let properties that have been sold, have not been sold to other buy-to-let. They've actually just gone onto the private market.
Yeah.
If buy-to-let owners ended up getting rid of their stock, and that ended up on the private market, increasing supply, giving other people a chance to get on the market, would that be a bad thing?
Again, I mean, way above my pay grade, but I can see why that might work quite well.
Yeah. Okay, great stuff. Nick Thompson again. Thank you, Nick. And more questions. We've got a few minutes left, so please do keep them coming. Jonathan talked about the hope and potential of the cavalry arriving to support the sector. Can he elaborate what interventions he thinks would be useful and what may be politically palatable?
I mean, that's a really hard question to answer, because those are questions that government are going to have to, that's for ministers and the government to decide. I think what I was kind of indicating is I think there are two things at play that might, I think, lead to some kind of cavalry arriving, although it might just be one or two horses rather than a full battalion. So one is I think some of the issues that we've seen play out in social media and on ITV News do really highlight some of the issues around complex flatted developments, building, and particularly tired complex flatted developments in high demand urban areas, particularly London, where individual tenants are experiencing quite poor living conditions, but actually it's very hard for the landlord to address some of those things, because they really speak to the fabric of the building, or they speak to the fact that you've got leaseholders above who won't allow access to the property, which means the landlord can't resolve the problem that the tenant is experiencing, or you've got a leaseholder who won't pay for the work that needs to happen unless everybody's paying that work doesn't get, all of those things that people will be well aware of. Yeah. I think all of that, the pressure is riding on that because of the media coverage, but there are no simple answers to those things, which I think does point you back to these are complex buildings, these are complex sites, they require multi-year, multi-million-pound investment in them, and they probably involve decanting, knocking down, regeneration. So I think a case can start to be built that is what needs to happen, and some of that will be cash, but some of it will be planning, some of it will be attitude of local authorities, some of it will be covering fire from central government. So I think that's part of it. I think the other thing that's driving in this direction is zero carbon EPCC in those kind of blocks, their whole block solutions. That it's very hard to get a flat up to EPCC, or to zero carbon. It's the block that needs to be put into that position. So again, that really drives, and that drives the conversation we were having earlier, Chris, about disposal of stock out of the sectors because you can't get it to zero carbon. I think I think that's one conversation where what you're dealing with is tired terrace properties in low demand areas in the north. It's a different question when you're dealing with flats in poor quality, high demand areas in London and elsewhere. So I think those dynamics, I think, push to government having to grasp this netly if it's serious about hitting its zero carbon, and if it's serious about trying to address what people are saying on social media. That's the dynamic. If the sector is going to have to come to the party on this, if you like. It won't be any good just sat around saying this is terrible, something must be done. I think the sector's got to begin to build a case that it takes to government and gets government to understand how you solve these problems.
Thank you very much. Are there any updates on what's happening right now with Grenfell and the cladding scandal? And I mean, is that still going to really affect the intercity areas we just discussed?
Yes, I mean the building safety works, go on. I mean government's obviously Michael Gove has taken a very tough position on leaseholders and leaseholders not having to pay for the cladding remediation work on their blocks, and I think that has put a lot of pressure on the owners of those blocks, and often that is housing associations, and I think a lot of associations will have developed some of those blocks, so there isn't anybody for them to go after because they were responsible. In some cases, they took the blocks, or they took parts of those blocks from the developer, and there's a question as to how much they can get those funds back off the developer. But in London in particular, getting hold of the skills and the material and the labour to carry out the remediation works is difficult, and some blocks are going to take a few years before you're able to get around and deal with them. And there's a real mix of stuff, where cladding's just wrapped around the whole building, like Grenfell, but there's also bits where there are bits of cladding and bits of stuff that needs to be removed across the whole block, but it's not, it's not of the same scale and the same intensity that we saw on the Grenfell Tower. So I think there's a real mixed picture, but certainly what's interesting is when you talk to organisations who are based in London, the thing they talk about most is cladding and building safety work and remediation work, and that's the big pressure they're facing now. When you step outside of the capital, it becomes EPCC, zero carbon, net zero. Those are the kind of building pressures that are most pressing for those organisations. So I think all this has done is it's taken capacity out of the housing association sector. It's taken management focus away from new supply, and I think that's all part of the story about why supply has dipped a bit from the sector.
Brilliant. Okay. Well, Jonathan, thank you. If anyone's got any questions, please do submit them now. We are approaching 10 to 12 now. And I think Jonathan, it's been a really nice, wide-ranging conversation. Thank you so much for joining us. We really appreciate it. What sort of advice would you have, just sort of finishing remarks, to housing associations moving forward?
Okay, so if we're going to be really blunt, the sector's got a reputation for whinging, moaning, complaining, and saying it's everybody else's fault. So whether you like that or not, whether you think that's fair or not, I'm not endorsing that view. I'm saying that's the reputation the sector has with politicians and with a lot of its stakeholders. So I think the sector's got to get better at its narrative. It's we were talking about building the case about regeneration and about planning reform and all of those things. The sector has got to get much better at building its case, showing how it's a really positive partner for government, and obviously governments change and government priorities change and all the rest of it. This is not easy stuff, but sometimes the tone coming out of the housing association sector is it's all impossible, and it's only possible if government gives us a big bag of money. And I think a much better solution would be, there are these problems that are important to you government, that we can help you solve. There's a range of ways we can help you solve them, and there's a range of things you can do that will help us help you solve them. But really, to change the tenor and the tone of the discussion with government from one that can seem very negative and sort of slightly whingy to one that is a bit more proactive and problem solving, and together we can solve this, government, if we work together and we do these things but you do those things. I think if you can change that tenor, that would be the single biggest thing I think the sector could do to help itself.
So be proactive. Let's start a better conversation rather than just saying, give us a big bag of money.
Yeah, and it's all terrible and we need a big bag of money.
Okay.
That does not land well.
Well, great advice, Jonathan. Thank you. We've got one question left. Will right to buy provide capital to RSLs?
So, I mean, the government is clear that the discount on the right to buy will have to be reimbursed. So yes, it will. I mean, there are loads of really interesting questions about what that does to the asset base. And I think it will play out differently across different organisations. If you've got a very active development programme and you've got the capacity to build more homes, the capital released will be helpful. If you're a smaller organisation without much development capacity, the cash, obviously you're losing an income stream, you're losing a tenant, you're gaining a lump sum of cash. Those things will both have value. In some places, one will have more value than the other, and in all cases, there's a question of what you can do to reapply to that capital you've got now that you weren't planning on having. So I think it will release capital. Whether it will be able to be used productively, whether it will help the HA more than having the income stream from the sitting tenant, I think will depend on the business plan and the dynamics within the organisation.
Yeah. So we have one of our products is called Stock Profiler, and it was we used James Laird from Sovereign, who was the asset director at the time, helped us develop it, and it's an extremely powerful data mining tool, because the problem he had with disposal was he needed to figure out quite quickly, and this is just disposals when a property becomes free. This isn't actually forcibly moving anyone out. He wanted to know whether or not this stock unit is something that's worth keeping, or whether we've got to dispose it, because its running costs are far greater than what it's bringing in. So it's a minus NPV. And he didn't know. And obviously it's Sovereign. So there's tens of thousands of units, so huge providers, we all know. But it is absolutely impossible to know sometimes. You will have the units that are negative, you will have the units that are positive, you'll have some units that start with positive NPVs and slide downhill. So it's an ever-changing situation, and you need live data for that. So right to buy is pretty much a lucky draw. Either you're going to lose money or you're gonna gain some. But I should imagine, from what I've heard, that it's probably a lucky draw where you have a much bigger chance of losing.
Yeah, I think that's probably right. I mean, that's certainly the experience of local authorities who've obviously been subject to this for a long time. The one thing I would say is, obviously this has been announced, but it's still not clear how much money is going to be available. It's not clear how many properties are going to be able to access this. I think Michael Gove is being reported as talking about sort of £500 million pot to fund the right to buy programme. Well, nationally, that's not going to cover many homes. So I think that there is still a potential that we don't quite know how this is going to play out. Basically, we still don't quite know whether this is going to be as big in the HA sector as in the LA sector, or whether actually this is just going to be a niche product available to a small number of tenants. I mean, that so much of that comes down to the design of the system, and frankly, the amount of cash the government has to make up the shortfall.
So it is quite a murky system, isn't it, right now? We do have a lot of phrases and slogans and ideas, but no real substance behind it.
Well, there's a lot coming out of government, and we're definitely seeing, with Michael Gove being a very sort of big political hitter and being in charge of the department, we are definitely seeing housing up the agenda in a way I don't think we've seen, for a very long time. And I think that is leading to quite a lot of announcements. And as you say, trying to put piece things together and work out the bigger picture is proving quite difficult.
Well, that is exactly, that's the climate, and that's what the government is very good at. Lots of big announcements, but not a lot of substance. So we're hoping that changes, and it would be great if Gove could do this and could work this out and get things to work, and we're all behind him on that. Right, so thank you very much. We're coming up to 12 o'clock, so I think it's a good time to leave it there. Jonathan, thanks. We really appreciate it. It's been a great conversation today. And are you going to be at CIH in Manchester next week?
I will indeed, yeah, and I'll be at CIH, absolutely. So
great. Okay, well, we'll be there as well. And if any of you are attending, please do stop by our stand. And yeah, I look forward to seeing you all there in Manchester. Thank you very much. And I hope everyone has a great weekend.
Thanks, everyone.
Thanks
for the questions.
Bye now.